Hello, and welcome to the 35th episode of the Market Pulse series. My name is Rufas Kamau, Markets Analyst at FX Pesa. So as you all know, today is Thursday. We have had the better part of the week. A majority of the major news that you're expecting for the week have already happened. And now we are looking at the last day, trading day of the week. And of course, deep insight into what we will be expecting to be happening in the markets next week. So just a quick overview of what we've gone through over the week. So I'll be sharing the economic calendar. And of course, once you join in, make sure that you type in the comment section, just type hi to confirm that everything is working just fine. So if you can hear me clearly, just type there, and this will inform me that everything is working fine. So early in the week, we started with what we call the S&P Global Economic Reports. So S&P Global is a company that basically does a research on major economies around the world, including Kenya. And once they do the research, they publish this every month. So they do so for so many economies, and this data is majorly focused on manufacturing as well as the services sector. So when the S&P releases this data, it's basically expressed as the Flash Manufacturing PMI, short for Purchasing Managers Index, and of course, Flash Services PMI. So what this report does, it basically does a survey through major industries within an economy. And on this survey, they will focus on the level of new business that has been created by the purchasing managers, or what we call procurement managers in Kenya. So once they take this data, they will carry this data in an index that runs from 0 to 100, with 50 being the midpoint. So the 50.0 midpoint basically means that the sector is not moving much. But then if a sector is above 50, that is considered to be expansionary. And of course, if it's below 50, that is contractionary. So they will compare this data every month, and it's usually taken as a leading indicator of the economic performance of an economy, of course, with a key focus on the different sectors. So manufacturing is a major thing for major economies. And for Australia, you can see Flash Manufacturing PMI came in at 49.6, a slight improvement from the previous reading of 48.6. But since it's below 50, it's still indicative of a contracting sector. So services came in at 48.0, which is lower than 50.3. So you can see the big shift here from expanding services to contracting services sector. So for Japan, manufacturing PMI came in at 49.4, lower than expected and lower than the previous reading. And you can see for France, 44.5 for manufacturing, 47.4 for services, with the biggest surprise of the release being the German Flash Manufacturing PMI, which came in at 38.8, which is way lower than the previous reading of 40.6, and clearly indicative of a sector that is going into a recession. So services are also slowing down in Germany, and for the entire Eurozone, we know that it dropped to 42.7, and of course, services also slowed down to 51.1. So for the UK, a drop to 45.0 in manufacturing, and a drop to 51.5 in services. A surprise rise happened in the US, where manufacturing improved from 46.3 to 49.0, and services slowed down to 52.4. So clearly, it's an indication of a slowing global economy. So less and less manufacturing happening, and of course, services that were creating a lot of jobs are also slowing down, indicating that the global economy is significantly slowing down. So besides this, we had a couple of more data points happening over the week. We had core inflation in Japan coming in at 3.0%. This was good for the Bank of Japan. Remember, their goal is to keep inflation just above 2%. And they are trying to observe this data over the next couple of months to see whether this inflation holds up at that level before they decide to change their monetary policy. So CB Consumer Confidence Survey in the US came in stronger than expected at 117.0 compared to the previous reading of 110.1. Then we had the CPI for Australia, where inflation dropped to 5.4% from a previous reading of 5.6. And of course, quarterly change in inflation was up 0.8% compared to the previous reading of 1.4%, basically showing that inflation is consistent with the Reserve Bank of Australia's expectations. Then the most anticipated news for the week was that the US interest rates, which happened yesterday in the evening, where the Fed hiked interest rates from 5.25% to 5.50%. So immediately after this happened, we saw the dollar weakening and stocks in the US continued to rally. And then 30 minutes later, we had the FOMC press conference, where the Fed chair, Jerome Powell, continued to say that they are moving to what we call a data-dependent approach. So on the next meeting, which will be in September, Jerome Powell insisted quite clearly that he's looking to observe the current data in the US economy that will be released between yesterday and the next meeting in September. And once they consider that data, then they will use that to make a decision whether to hold interest rates at this level of 5.50% or whether to continue hiking higher. So as a result of that, we saw the dollar continuing to weaken against other currencies, whereas we saw measures like pound USD, euro USD, all gaining against the dollar. And of course, even gold was trading higher. So fast forward to today, we saw the European interest rate decision happening, where the ECB went for a 25 basis point hike from 4% to 4.25%. So immediately after this, we had a surprise drop happening in the euro USD. So the euro was basically majorly losing against other currencies as the ECB press conference convened 30 minutes later. So 30 minutes later, we had the ECB press conference where Christine Lagarde insisted in a policy decision that is similar to the US, that they are looking to be data dependent. So they will be observing the economy, collecting all that data, analyzing it, and using that data to make the next interest rate decision on their next meeting. So notice that immediately the news were announced on interest rate decision in the Eurozone. That was 3:15 p.m. We also had some more news coming in at 3:30 p.m. So at 3:30 p.m., we had a sequence of very positive news coming in from the US. First, advanced GDP came in at 2.4%. So this is inflation adjusted GDP or economic growth in the US. And it shows that between the month of April and June this year, the US economy grew by 2.4%. So the overall expectation was 1.8%, and the previous reading was 2.0%. So this was a surprise indication of the strength of the US economy. Then we had unemployment claims, which came in slower than expected at 221,000 jobs. So these are the number of people who are claiming for unemployment insurance. So the fact that this data point is dropping from the previous reading of 228K to 221K, it shows that this data movement is consistent with what the Fed is looking to achieve, but the GDP is not consistent. The US economy is growing too fast, and this is according to the Fed. So if the economy is expanding too fast, then it tends to be inflationary. You tend to see prices rising or the currency losing value, and the Fed doesn't want to see this. So besides this, we also had what we call the advanced GDP price index, which came in at 2.2%. So this also was quite a slowdown from the previous reading of 4.1%, and of course, lower than the expectation of 3%. So that data point is also consistent with what the Fed is looking to achieve. Then we had the core durable goods orders. In this case, you can see there was a big jump from the expectation. So investors were expecting that this would be at 0.1%, but the actual reading was 0.6%, slightly lower than the previous reading of 0.7%. So durable goods orders month over month in June was up 4.7%, compared to an expectation of 1.3 and a previous reading of 1.8%. So far, two very important data points showing a surprise rise, advanced GDP in the US, core durable goods, and of course, durable goods orders. So the goods trade balance basically improved from a previous reading of negative $91.9 billion to negative $87.8 billion, basically meaning that the US is exporting more than it's importing. It's exporting less than it's importing. So we know that the US is a net consumer. Basically, imports more products than it exports. So in this case, there was an improvement in the balance of trade, and this was good for the economy. And of course, the preliminary wholesale inventories basically went into the negative, basically showing some form of slowdown in wholesale stock. So after we saw this happening, it was quite a surprise in the markets. We also had some more data supporting the economic strength in the US. We had pending home sales improving by 0.3% in the month of June, compared to the drop that we had experienced previously at negative 2.5%. And of course, the expectation of negative 0.5%. So the fact that home sales are rising is also a big problem for the Fed. It's not something that the Fed was looking to achieve. So when you take this collectively, we have a Fed that decided to hike interest rates on the meeting yesterday, but then they decided that on the next meeting, they will be data dependent. So the data that is coming in from the US shows a very resilient and healthy economy with a 2.4% growth. Core durable goods orders and durable goods are currently rising strongly. The goods trade balance is improving, and wholesale inventories are also improving. Actually, in this case, dropping. So we don't have a lot of goods in stock, but on the other hand, we have a rise in pending home sales. So this basically paints a picture where the Fed may have to continue hiking interest rates if they are going to use this data to make a decision. So as a result of that, we saw reversals happening this afternoon in major currency pairs. So while the benchmark index, or what we call the dollar index, or the DXY, was previously rising and then dropped sharply yesterday after the Fed meeting. So you can see the Fed meeting and the effect it had on the markets, where the dollar index was losing. Today, after the announcement of a series of positive data for the US economy, the dollar index strengthened, and within 3 hours, it had erased the losses that we had seen over the last 3 days. So this caused some major shifts in major trends. So for pound USD, after making some good rally for the week, I think Monday, Tuesday, Wednesday, and then Thursday, you can see the sharp drop, erasing 2 days of gains within a very short period. And of course, for Euro USD, it was the biggest loser so far. So after experiencing 2 consecutive days going up, you can see the big drop that happened here as investors were betting on a stronger dollar compared to the euro. And then for USD JPY, you can see how the dollar basically strengthened against the Japanese yen. But then once you go to this trend line, you can see the Japanese yen is pretty strong, and there was a major reversal here. So if you look at USD CAD, a big jump here with the dollar gaining against the Canadian dollar. And the dollar was also gaining against gold. So I believe a majority of retail traders who are expecting the completion of this cycle, which would look like a cap and perhaps a handle. They were caught off guard expecting the price to get to this area, and then the market just drops sharply all the way down. So sometimes these things like this will happen in the markets. So you have to be prepared, and of course, always practice proper risk management so that whenever there is such surprising moves, you're not caught on the wrong side and you don't lose more than you had planned to lose in a trade. So for AUD USD, it had broken this particular trend line. We're expecting some further upside, but then the trend was reversed immediately and the market dropped all the way to the support level. So for US equity indices, they weren't affected much. So we were expecting that equities will continue to rally, especially looking at the earnings from major companies such as Netflix. We saw positive earnings from Tesla, Google, as well as Microsoft. So as more earnings continue flowing in, it's boosting the confidence in the markets, and we're expecting some further upside. So also for the Dow Jones, you can see we didn't have much of a reversal. And of course, for the S&P 500, there was a sharp drop, but you can see the market is quite resilient and it's attempting to move higher. So as for oil, there was a break towards the upper side and it seems to be continuing. And then for the French benchmark index, that is the CAC40, there was a very nice rally happening for the entire day. And so far, it hasn't stopped. So it seems like the market is pretty strong, especially considering that the ECB was not very hawkish on its meeting. So the fact that they are considering holding rates level and ending the rate hike cycle, then we are seeing some very strong momentum happening in these European indices. So in the morning, we had projected that the market would break some of these trend lines. So this major resistance was being tested, the market broke and went higher. And of course, we also projected the same for the EU 50 or the Eurostoxx 50 cash index. So we had some very nice rally. The market tested this resistance and then broke right through it and kept going higher. So that's basically a summary of what has been happening in the week so far. So as we proceed with the rest of the week, remember, we'll be having more data coming in tomorrow. And one of them will be the Tokyo core CPI, which is an inflation measure of the capital city of Japan. We're expecting that this inflation will slow down to 2.9%. Then we'll also be looking at interest rate decision by the Bank of Japan. We don't expect much of a change, so we'll be expecting negative 0.1%. But then the monetary policy statement and the Bank of Japan outlook report could cause some volatility in the markets. And the most anticipated decision will be from the Bank of Japan press conference, where the Bank of Japan will be clarifying what they want to do with monetary policy over the next couple of months. And this could cause volatility in Japanese yen pairs. So besides these, we'll also be looking at the GDP month over month for Canada, core PCE price index month over month for the US, and of course the employment cost index. Then later on, we'll be looking at personal income month over month, personal spending month over month, and revised UOM consumer sentiment data. So that could cause some good volatility in the markets. So I'm just realizing I wasn't sharing this. So for the core PCE price index, this is the Fed's favorite measure of inflation. So when we focus on this data, we'll be looking to see the change month over month. That is the change that happens in the month of June. And if inflation is actually slowing down towards the Fed's target of 2%, then in this case, we will be expecting another form of reversal to be happening in the markets as investors try to process this information. So from the Fed's meeting yesterday, it basically put a target on inflation where investors will be majorly focused on US inflation as a leading indicator of the Fed's decision. So far, if you look at the CME group FedWatch tool, it's basically the tool that uses the futures contracts to speculate on the direction of interest rates. And as you can see, yesterday, the percentage or the expectation for another rate hike in September was really low. But then after the commentary by Jerome Powell, the percentage started going up. So yes, this already passed. It was at 80%. And this was the previous reading. So now that interest rates are between 5.25% and 5.50%, the decision to hold interest rates level on the next Fed meeting is expected to be at 78% possibility. So there's a 78.0% likelihood that the Fed will hold interest rates level on its next meeting in September. However, there's also the alternative where the Fed could hike interest rates, and this was at 20% yesterday, and now after the data I just showed you, then there's a 22.0% likelihood. So once we get the PCE price index data, if there's a very low inflation, then we could see this percentage moving higher and this dropping lower. And of course, the alternative is also true. So if inflation is spiking higher, then the potential for another rate hike would increase here, and this other one would reduce. So the CME group Fed futures tool is usually quite accurate in predicting the rate hikes. So you might want to study it before using it, and I'll be sharing a link just in case you want to go through it on your own. So hello, Boniface. Hello, Kisan Molombe. Haven't seen you in a while. The digest, I believe that's your username, not your real name. Kevin, and of course, Trader FX and Peter Mtungi. What just happened to JPY pairs now? So for JPY, we know that the Ministry of Finance have been threatening to intervene in the currency market, and they don't normally announce when they're intervening in order to avoid getting into a deadlock with speculators in the market. So it's something that we've been expecting. So there's a good chance that the Bank of Japan is intervening in this market. So interventions have happened before. So the top that we saw here, which was last year, was as a result of intervening, and the prices basically reversed like 50% of the entire move we had over the better part of the year. So now that the prices were approaching the previous high, this was becoming quite negative for the Japanese economy. So in this case, whenever you see such a big jump happening, then it's usually often as a result of the Bank of Japan intervening. So I'm not sure about this, so I don't have the facts. I'm only speculating on what there may have happened. But once we look into the news, there's a good chance we'll be looking at the BOJ intervening in the currency market. And when it's intervening, we know that the Japanese yen can get pretty strong. So what we do is buy the yen against the weaker currencies. So that might be a play going forward for the end of the week, and of course, right into next week. So if you have any question or comment, feel free to type that in the live comment section, and I'll be responding to that right away. So on the next part of the presentation, we take a brief outlook on what we might be expecting to be happening in the markets next week. So we have only covered Friday, where we have seen the core PCE price index, inflation data from Tokyo, and of course, the interest rate decision and the Bank of Japan press conference tomorrow. So on Monday next week, we'll be getting preliminary industrial production data from Japan. Now this is the official number. We'll also be getting retail sales from Japan. Before we look at MI inflation gauge in Australia, ANZ business confidence survey in New Zealand, and of course, manufacturing PMI for China, and of course, non-manufacturing PMI for China. So later on, we'll be looking at a CPI flash estimate, which is basically, core CPI flash estimate for the Eurozone, which is basically an estimate of inflation in the Eurozone. Then interest rate decision from the Reserve Bank of Australia, which is expected to hold interest rates level at the 4.10% level. Then as we continue, we'll get a host of manufacturing PMI data. Now this will be the official data points from the European Bureau of Statistics, rather than the data that we had earlier in the week for S&P Global. So I think I'm losing my battery. So we just fix this. Yeah, it's done. So final manufacturing PMI for the US, as well as the ISM manufacturing PMI, JOLTS job openings, and of course, ISM manufacturing prices. So this could cause some volatility in the US. Dollar pairs, then New Zealand jobs market. We'll be getting some data from that. ADP non-farm payrolls. And then on Thursday, we look at Swiss CPI, or basically inflation data coming from Switzerland, Chinese Kaizen services PMI, and of course, towards the end of the week, there will be two data points that will be most important for the markets. So the first one is the interest rate decision by the Bank of England, where there is consensus estimates that the Bank of England will hike interest rates to 5.25%. This could be pretty much positive for the UK pound. There will also be MPC official bank rate votes, monetary policy report, and a speech from the Bank of England Governor Bailey. Then unemployment claims from the US, ISM services PMI from the US, and then the non-farm payrolls on Friday. So it's easy to assume that next week will be the non-farm payrolls week, which can pretty much dominate the market sentiment as investors prepare for the jobs report. So we'll be looking at the employment change in Canada, the unemployment rate in Canada, average hourly earnings in the US, non-farm employment change, and of course, the unemployment rate in the US. So that's a quick overview. So it means that the most anticipated news for the next week will be the jobs data for both Canada and the US on Friday, the interest rates in the UK on Thursday, ADP non-farm employment change on Wednesday, and of course the jobs data from New Zealand. Then on Tuesday, ISM manufacturing PMI and jobs job openings from the US. Then interest rate decision Tuesday in the morning for Australia, and Monday is largely quiet. We know with the only major news being the manufacturing PMI from China. So now that we know what to expect, then we can look at potential plays that could emerge in the markets. So from the current price action in USD JPY, we know that if this momentum continues happening and there's a confirmation of Forex intervention, then the immediate target goes all the way down to the previous low. So this could be a nice trend going all the way back down to the previous low in USD JPY currency pair. So as for gold, we are seeing a very sharp drop happening here. So if we happen to see information that is supporting less chances of a rate hike by the Fed, then gold could potentially recover. So remember, early in the morning, I was already projecting that gold could get to the $2,000 price level. But then this did not happen. And of course, gold could make some form of recovery from this point after the big surprise sell-off. So think about it this way. At these levels, there was a lot of traders who had set their stop losses here. So if you had a buy on this trade over the last 3 days, there's a chance that your stop loss was somewhere around this area. And if it was not along this area, then it was probably along this area. So notice that gold has already cruised through both levels. So all the stop losses have been eliminated. And now there's a good chance the market could continue rallying again. So the support here serves quite well. It has already been breached. So anyone with stop losses below that has already been triggered. And now we could find some efficiency, the market starting to make a recovery. So for the indices, I think the French 40 index has made its significant move for the week. And at some point, we could be expecting to see some form of pullback. So this has not happened yet. So we just have to be patient, observe price action. Maybe it will form some level of consolidation before presenting a trading opportunity. And this is the same case for the Euro stocks index. So for the UK 100 index, it's what I'm talking about with the other indices. So whenever there's a big move such as this one, sometimes we expect the market to cool off for a while in what we describe as a consolidation zone. So this one took quite a number of days trading around this area here. So you can see this was the triangle that the market was forming before moving into the next leg. So after this big momentum, the market traded sideways for a couple of days. Then it eventually breaks out of that and then moves all the way up and then forms another form of consolidation before showing you the direction it's taking. So for the UK 100 or the FTSE 100, I can use this low that we had here and then compare with this other low. And of course, for the highs, we do the same. So we try to find a line of best fit that would help us identify a breakout. So if these are a line of best fit, basically trying to estimate the area around which the market has been unable to break, then with this, you can monitor a potential breakout. So there is a good chance if there's a breakout towards the lower side, we short. If there's a breakout towards the upper side, then we go for a long position. So for pound USD, now that we know that we're expecting a decision to be happening from the Bank of England, these large-scale sell-off happening right now may not hold for long. So I don't believe that the dollar index will be making such a big recovery from the current price level. So even though there was a big jump at some point, I expect the dollar index to start weakening as the market price in the possibility that the Fed could not continue hiking interest rates. So in this case, once we see the dollar index cooling off and perhaps reversing, then that will be an indication that there's a good chance to now start accumulating the pound USD. So in this case, there's a good chance we could be finding some bullish positions, not at the current price level, but probably at 1.2799986 around the support area here. So for now, the thesis is the market continues with the current trend. So if you are already late in the trend, it may not make as much sense to trade here if you did not enjoy the entire move from the top. But then once you get here, there's that potential that the pound will start recovering as we look forward to the Bank of England interest rate decision next week. So this is an area to be very observant about, which was a low actually on Monday this week. So in this case, if the market gets to Monday's low, then we start observing for opportunities here. So for Euro USD, it's something similar. The market has been dropping sharply, and now we are at a major decision point. So now from this point onwards, I don't expect the Euro USD to continue dropping at the same pace it was doing earlier in the day. And in this case, you just have to be observant, look at the price action and look for signs of bullish entry. So if there's some form of reversal, this could be a nice entry. For USD JPY, we have already covered these. USD CAD is basically moving sideways. So it's trading inside this triangle, moving up and down, and then up and down, up and down. And now we are on an upswing. So it's a very clear path for me that the USD Canadian dollar pair is moving back to the previous resistance. So as for gold, it's testing a major level. Of course, there's a good chance it could also break and get to an even lower price. So if it breaks, we also look at other price levels that was previously acting as resistance, and now they could act as support. So 1934 becomes the immediate target if gold was to breach this area and continue going down. But then if this doesn't happen and gold starts making a recovery, then we could be targeting this area again around the 1963 price level, which has been quite instrumental this year. So in this case, I just observe the price action here. If there's signs of bullish entry, we go up, but a continuation will get us to 1934. So for AUD-USD, we are testing a major support level at 0.67249. So a breach below this will go short, and of course a bounce from here, then we go to the previous high. So as for the Nasdaq, you can see the big sell-off, but it's already testing a major resistance level, which was acting as support here. So 15,600 seems like the immediate target. So if the Nasdaq is unable to break this area, then it could continue with the original direction. So for the Dow Jones, it's trading within a very tight range. So if you look from the 1 hour chart, you can see it's a bullish channel. It has quite a number of swings. So if I was to draw a trend line here, it would most probably fall along this area here, and this other side, it would fall along this area. So it's a very strong bullish channel, and now we are seeing the the Dow Jones bouncing from the upper trend line with a very nice pin bar or a shooting star. Then from here, headed all the way down to the lower trend line. So we will be looking for opportunities from the lower side. And of course, if you're already in the position, then you know the target is on the lower side of the channel, around 35,409. And once the market gets here, it could potentially bounce and continue trading within that channel. So for the US 500 or the S&P 500, after the big rally that happened earlier in the day, right now we are experiencing a big sell-off. So now the lower trend line comes back in mind, and the price, given the current momentum, could potentially continue dropping and eventually get to the lower trend line here. So as for Brent oil, it's break after break. So I remember mentioning last week that there's a good chance that oil prices could rally from this area here and get to $80 per barrel. So earlier this week, we broke the $80 per barrel level. We kept going up, and now you can see after the triangle that was formed here, the market was able to break to the lower side, retest all the way down, and then continue rallying. And today we touched $84 per barrel. So there is a good chance we'll be seeing some further upside. So in this case, a pullback might be necessary to look for entry positions. So if the market makes a pullback, say to retest this area, then we could be looking for potential entry points for a bullish position. So this is the area that we should be monitoring most. So if the price was to pull back to this area, then we could look for bullish positions in this particular market. So last chart is Bitcoin, which is now trading within a very tight range. So if I was to use the 50 minutes chart, then it's very clear. This is what we are seeing. Market that is following this path. So it's on a bullish channel. And now it's just retesting the lower side of the channel. And you can already see a very nice pin bar happening here, or a hammer. So from here, you can see a rejection of lower prices. So chances that the price will bounce and start moving higher, increasingly higher. So New Zealand USD also dropping. Remember, the dollar is currently very strong. So if this kind of momentum continues, then we could be seeing the New Zealand USD resume the previous low of around 0.61579. So that's it for the day. Thank you very much, guys. Thank you for your time. I'm just checking to see if there's any questions I may have missed. Was doing exams. I'm back now. Welcome back. Repeat pound USD. So for these sessions, they're usually live. So if you missed something and you want to go through it again, the session will be immediately live on YouTube. So you're able to basically replay and go back to an area that you feel that you missed and then go through it. There's very big impulse move because of data dependence by the Fed, I think. How do you personally trade with these impulse moves? So as I mentioned, there's a lot of data that came in today regarding the US economy that influence the current moves. So the fact that the Fed is now data dependent, also the market is data dependent. So we don't have a straightforward policy for the Fed. We don't know whether they will hike or hold, but the data that is coming in the economy is the one that is influencing the decisions by investors. So the data we had earlier in the day was quite positive. So advanced GDP going up 2.4% is not consistent with the Fed expectations. So unemployment claims was consistent by slowing down. Actually not slowing down. If you see unemployment claims going down, basically means that the labor market is very tight. So if there is less and less people claiming for unemployment insurance, it means that the economy is creating sufficient jobs. So if the job market is hot, this is not consistent with the Fed. Advanced GDP price index, this was consistent with the Fed, but then core durable goods orders coming in stronger than expected. Durable goods orders coming stronger than expected. Goods trade balance stronger than expected. All this is not consistent with what the Fed is looking to achieve, including the preliminary wholesale inventories. And of course, pending home sales were improving in in number. And all these, and it's basically the housing market heating up. All this is inconsistent with what the Fed is looking to achieve. So as a result of this, the market is now pricing in a higher likelihood that the Fed will hike interest rates on the September meeting. So this explains why we are seeing a stronger dollar, despite the Fed hiking interest rates yesterday and giving a very blank or grayish monetary policy statement. So I hope that answers your question. So now we'll be going data by data. So if we have positive data for the US economy, that's bad for the Fed, then it means higher interest rates. If there's inflation cooling down and the economy cooling down from the data, then that would be taken as consistent with the Fed, and then that would be taken as a potential stimulation to hold rates level. Why is almost all positions falling? Mainly because the dollar is the world reserve currency, and most of these assets that we have discussed today are priced in the dollar. So if the dollar is strengthening, then the overall effect is the same. The dollar strengthening will basically drive currencies such as USD and USD CAD downwards, gold downwards, and so on. So thank you very much, guys. Also remember to share these sessions with your friends as well as your communities. Subscribe to the channel. We are almost getting to a record number of, I think it's 23,000 subscribers. We will really appreciate these. And of course, remember to watch the recent episode of the Bullish Banter podcast. So the next episode of FX Pesa presentation will be happening tomorrow in the morning at 11 a.m. And it will be presented by Samson Mzera from Eldoret. And hopefully you'll get to gather more insights about the markets. So if you want to get prepared for your day, then you join in at 11 a.m. So it appears like the US economy has ignored the rate hikes. Yes, it's not ignoring the rate hikes. It's basically two policies that are contrasting each other. So while the Fed is tightening the economy and hiking interest rates, the fiscal side, which is basically the administration, the Joe Biden administration doesn't have any fiscal discipline. So they're spending money, just spending and spending and spending. And this has the effect of basically inflating asset prices. So the fact that we are seeing stock prices rise, it's not a result of the Fed actions. It's majorly as a result of the fiscal spending, which is basically regulated by Congress. So every time they pass a new bill, even the Inflation Reduction Bill, basically passed over $600 billion to be pumped into the US economy. So these guys are just spending money like it's nothing. And the result is that most of this money will find itself in risky assets, which basically includes shares as well as real estate. So that explains why we are seeing the housing market heating up. And of course, the business sector or the private sector is also doing really well. So as a result of the fiscal spending, that's why we are seeing the US market ignoring the interest rates.